Oil prices settled in the red zone on Friday amid escalation of the trade war and dovish comments of Fed Chair Jerome Powell. Last week, Washington and Beijing performed yet another tit-for-tat in the lingering trade conflict, threatening to slap new tariffs on each other. Moreover, China announced plans to impose tariffs on imports of crude oil from the US. It caused a rise in the spread between Brent and WTI benchmarks as the US oil prices slumped. Thus, WTI prices settled near $53 per barrel last week. At the same time, Baker Hughes released its oil rig count report on Friday. The report showed that the number of active drilling facilities in the United States declined by 16 units in a week to 754 units. In annual terms, this number fell by 106 units. A decline in the drilling activity is a sign of a possible reduction of the U.S. output in the second half of the year. At the same time, new pipelines are due to be opened later in the year, which can help the country to ramp up production of shale oil. However, uncertainty regarding the demand for crude oil limits a rise in the commodity prices. Still, the quotes attempted to return to the recent highs in early deals. Thus, the Brent crude benchmark has approached the level of $59.70 per barrel. However, oil prices are likely to be trading lower this week. Financial markets have factored in a new round on the escalation ladder in the US-China trade conflict. After Beijing had announced intentions to impose tariffs on the American goods worth $75 billion, Donald Trump asked the US companies to stop cooperating with China. At the same time, the US senators demanded that the country's pension funds restrict money transactions in China. So the emotions were running high. However, later in the American president said that Beijing requested Washington to resume the negotiations in a recent phone call. In response to this request, Donald Trump's team is about to initiate a new round of negotiations, the president noted. The risky assets such as the ruble came under pressure amid escalation of the trade war. However, the willingness of both sides to resolve the conflict is a favorable factor for the Russian currency. Thus, the dollar-ruble pair retreated to the level of 66 points at the beginning of the week. The pair is likely to be stuck in a wide trading range between 65.3 and 66.5 unless the situation on the global trading floors changes drastically in the coming 2 or 3 days. The commodities and the EM currencies remain vulnerable to the news about the conflict. The strong desire to pursue the protectionism policy can affect the global economy that had been showing signs of weakness throughout the last year. We keep close tabs on the market developments. Stay tuned.